Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. If you're new to the channel, make sure you subscribe. This is the place to go for high quality, free trading education. Now, without further ado, let's jump straight onto the charts. In this video, I will be speaking about gold. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect of this market by performing a complete multi-time frame top-down analysis. Then we will move to the order flow analysis by looking at the commitment of traders, specifically what the non-commercials, so the biggest speculators in the market are doing, which are hedge funds, so the big players in the market. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here on this pair. Now, starting from the monthly time frame, what we can see is that at the moment we have a market which is testing a quite strong historical structure level. In fact, this zone is exactly the area that stopped the market here before then creating all this rejection to the downside. Again, here the market tested its zone and rejected it to the downside. And at the moment we just entered exactly the same area. Now, in a situation like this, since this time we just had a minor test, we could expect a bit more bullish price action for a deeper test of the zone as we had in the previous cases before then getting a potential rejection lower. So at least in the short term, we could expect a bit more bullish price action to be developed, essentially inside of this resistance zone. Dropping down on the weekly, what do we see? Now, from a weekly perspective, first of all, I did speak about gold a few weeks ago. I spoke about gold exactly when we were here, and I explained all the reasons for which from here we could expect this rejection to the upside, which is in fact exactly what the market did. And by the way, I will link in the description that previous analysis so you can go and check it out for more free education, because there were many confluences all lining up at this zone. For example, we had the previous weekly resistance currently acting as support exactly here, and we also had the 0.618 of the Fibonacci taken on this weekly impulse, both lining up exactly at this zone, which is in fact precisely the level that the market tested before then getting rejected to the upside. And by the way, that is exactly what you usually expect in an ideal uptrend. In fact, when you have an ideal uptrend, you expect the market to create a series of higher highs and higher lows in which every time the market goes and tests exactly the previous resistance turns support. Now, in this case, that is exactly what the market did here, going and retesting the previous resistance turns support, then again here. And in a situation like this, we could expect a similar thing, the market to go and test this previous resistance turns support, and then go for a deeper test of the monthly resistance that we have identified at the beginning of the video. We can also notice how, again, here on the weekly, we have an impulse followed by a correction. And in general, if you have an impulse and you want to measure the correction, what you have to do is take your Fibonacci from the low to the high of the impulse leg. And if we do that, we can see how we have a 0.32 Fibonacci retracement lining up perfectly with this previous resistance turn support, creating a confluence of support at this area, which we could expect the market to go and test before then potentially getting rejected to the upside. Going down on the daily time frame, what do we see? Now here on the daily, we can see that essentially we had an impulse and at the moment we're getting horizontal price action. However, if we follow the movement of the market, expecting a potential short-term drop, what we must notice is that if the market actually creates this move to the downside from here, at that point what we would have is the creation of a daily M pattern, because we have green, red, green. If from here we get a move to the downside, so a bearish move, we would essentially have the creation of this daily M pattern, which would at that point also be testing that confluence of support that we have just identified on the weekly. It would be testing this zone here, which is previous weekly resistance turn support, and also the 0.32 of the Fibonacci taken on this weekly impulse, as we have just identified. Now, generally speaking, after the creation of an M pattern, as we said many times, what we would expect is a potential rejection higher for the completion of the M pattern at the neckline, which is the previous support turned resistance, meaning that we don't know if the market will create this M pattern, but if we do get the creation of this M pattern, at that point we would have very good probabilities of seeing a potential rejection to the upside for the completion of the M pattern at the neckline, which at that point would also complete and reject the 0.382 of the Fibonacci taken on the weekly impulse as we have identified previously. Now, if we go and see what we have when it comes to the commitment of traders, so the COT data, which is what the non-commercials, so the biggest speculators in the market are doing, and we check the data specifically for gold, what we can see is that with the last report, we had a huge increase of the net positioning from an institutional perspective. We went from having 98K net positions all the way up to having 140K net positions, with 15,000 longs added with the last report and 26.6K shorts getting closed on the institutional side of the market, bringing the shorts down to 90K and the longs up to 230K. So clearly, we had a massive decrease of shorts and increase of longs on the institutional side of the market. This increases the probabilities that if we will have the creation of this M pattern, a potential rejection to the upside is possible because institutions are currently accumulating longs on gold and closing shorts. So if we will have the creation of this M pattern, how we could be approaching a potential move higher. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily combined with the COT data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, what we could be doing is monitoring price action from an intraday perspective during this move to the downside, waiting for the market to shift from an intraday bearish market as we would have to an intraday bullish market. And if the market would shift from an intraday bearish to bullish market and provide to us one of our valid entries, at that point we could be looking for a potential move higher for the completion of the M pattern at the neckline. Now, if you don't know what I'm speaking about when I say valid entries, this kind of things, you want to learn more, I really suggest that you go and check out the mentorship program, which you can find at transparentfxtrading.com. In fact, now completely for free, you have the possibility to gain access to all my courses with all the rules of the strategies. You also have the possibility to integrate with one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the COT data software, which is the one that we used precisely in this analysis, the trading station software, which puts together everything that you need as a trader all in one interface. And if you continue to scroll down, you will see that directly from here, by following these 3 easy steps, you have the possibility to get free access to the mentorship program. So I really suggest that at least you go and check it out at transparentfxtrading.com, and I will see you in it. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis, education, and updates for all of you, and I will see you in my next breakdown.